Hello and welcome back to The Note. One of the biggest surprises of the year so far has been that it's actually been quite a strong year for Treasury bonds. And that's a surprise because the speculation had been that after a 30-year-long bull market in Treasuries, that was finally going into reverse. So what is happening this year? That assumption doesn't look so strong. And similarly, what kind of opportunities might there be in corporate bonds as well? With me now to discuss this, the ideal candidate. He's the head of fixed income for Prudential of America, Jim Sullivan. Jim, thank you very much for joining me in London.
Thank you for having me.
Let's start by taking a look at a classic chart. This is the bull market in Treasuries writ large. Yields have been steadily falling ever since Paul Volcker in the early 1980s. Everybody thought we had finally hit bottom sometime in 2012, early 2013. Now we're reconsidering. What do you think is going on?
Well, I hate to be the bearer of bad news or good news, depending on which side of the coin
Good news if you're a bond investor.
Good news if you're a bond investor. I think the news in the end of last year was slightly overdone, in that the news of the Fed tapering began to allow rates to come back off, and they came up quite a bit. And the 3.5% long rate was looking rather cheap, whether you want to look at a funds terminal level in the future or whether you want to compare it to bunds or even rates in the UK. So it was a very attractive level, given what news was baked into the marketplace.
Okay, so people have found it an opportunity to buy. The bull market is not necessarily over just yet, you think?
We don't believe so. We don't believe so. It called for very little news in the first quarter to really allow that trend to turn around and come back down and to continue a rally. First off, we had bad weather in the United States.
Right.
We had some geopolitical events here in Europe. We had a slowdown in China, and also some unfortunate news with the consumption tax hike in Japan. So global growth has slowed a bit, more so than expected in the first quarter. But having said all that, I think that the market began to realize that there's an awful lot of cash in the system, and U.S. rates look very attractive from a long-term perspective.
Okay, so all of this, if you're a bond investor anyway, is good news. Now let's take a look at the corporate bond market. This is a chart you put together for us. Where do you see spreads are obviously tightening quite noticeably post-crisis. Where do you see value in corporate bonds at present?
Yeah, corporates, although very tight, historically speaking, they're not as tight as they used to be back over a decade ago, and we believe we could challenge those levels again.
Really?
Currently in the U.S., we like money center banks, so we still like financials, although their balance sheets probably have peaked after a 5-year cleansing by the regulators. We believe that they're not going to dip down and start making debt unfriendly type of activity to their balance sheets. So with the supply, they cheapened up in the first quarter. We still think that there's a lot of value in financials, especially in money center banks in the United States.
Europe?
In Europe, slightly different story. There are banks, we might like Scandinavian banks, might like banks here in the UK.
But not in the Eurozone.
But not in the Eurozone. I think that there's still a degree of deleveraging to go. So we're a little bit more in favor of some industrials here in Europe. Traditionally, Europe has been a little bit better in terms of the event risk versus industrials in the United States, although some of the news lately may not prove that out. However, in the long run, we see a lot of value in infrastructure type of issues here in Europe.
Okay. Now let's finally take a look at high yield bonds, popularly known as junk bonds. Looks to me from this chart that you prepared as though we're really not being very adequately compensated for the extra risk you're taking in that sector. Is that a fair assessment?
I think it's a fair assessment if you go back and look over history and not think about a new paradigm going forward. But if we were to think about what's happening in the marketplace today, we have minimal growth going on globally. We have virtually no inflation. And we have expected default rates to be very much declining from here, both in the United States as well as Europe. Given that, I think that you still could find value in the high yield market. You just have to be very careful to see where we're overdone. So in the United States, we kind of feel like the double B area, the high quality end of the spectrum, is the better place to be because of the compression of spreads. You're not really being paid to go down too far in the quality spectrum. Here in Europe, you've had too many fallen angels, and the double Bs look a little rich, and the triple Cs look a little over-levered, where in a normal credit cycle, they probably would be increasing defaults right now.
Right.
So it's more of a bulleted approach in the middle part of the quality spectrum in Europe, which is where we see value.
Okay, Jim, thank you very much indeed. That was a very clear and broad summary of the world, and I think the main point to be made for investors out there is that the world really does look like quite a good place for bond investors at the moment, and that should imply that the many very optimistic equity investors should check their assumptions a little more carefully.